The way most people manage wealth is structurally vulnerable. One market cycle, one lifestyle inflation decision, or one public visibility mistake can erase capital that took decades to build in just a few months. Self-made decamillionaires know this, so they refuse to manage wealth the way financial experts tell you to. They use 5 private systems that operate silently and automatically to keep their assets invisible to the outside world. Getting rich and staying rich are different games with completely different rule sets. Most people study the first one by reading books on income, side hustles, and market timing. They chase the highest return and the fastest growth, but the people who actually preserve generational wealth operate on a completely different architecture. It is not about earnings. It is about systems that protect capital from the world, from your own impulses, and from time itself. The ultra-rich do not think about money the way you do. If you looked closely at their daily habits, you would notice something almost counterintuitive. None of them are doing what financial experts tell average people to do. They are practicing specific habits that almost no one talks about, which silently compound into generational wealth over time. The privacy protocol. Most people broadcast their financial lives without thinking. They share net worth updates, post photos of new purchases, and treat visibility as a form of status. Self-made decamillionaires do the opposite, and they treat financial visibility as a liability. This is not about secrecy. It is about control. Researchers call this the privacy paradox. Most people say they value privacy, but they trade it away for convenience every single day. The wealthy do not make this trade. They structure their finances so that disclosure is intentional, limited, and legally bounded. The evidence is measurable. After Apple introduced app tracking transparency, 83% of iOS users opted out of data sharing. In areas where opt-out rates were higher, consumer fraud complaints dropped by over 13%. The NBER study that tracked this found a direct link between limiting data exposure and reducing financial harm. A 10 percentage point increase in opt-out rates translated to a 16% reduction in fraud complaints. The pattern is clear. Less visibility means less vulnerability. World Bank researchers ran a similar experiment in Nairobi. They offered customers 2 loans, where one was cheaper but required extensive personal data sharing, and the other cost 10% more but protected privacy. 64% of people chose the more expensive loan. They paid a premium to keep their information private. In Bangalore, 66% made the same choice. Privacy has an economic value that most financial advice completely ignores. Self-made decamillionaires apply this same principle at scale. They use Rule 506C frameworks, private fund structures, and limited disclosure vehicles that keep their holdings out of public databases. Rule 506C allows general solicitation only when every investor has been verified as accredited, which creates a legal architecture for selective transparency. Their wealth isn't hidden because they are paranoid. It is protected because they understand that information cannot be recovered once it has been exposed. Once your holdings are public, they are public forever. Once your strategy is visible, it is vulnerable to competition, regulation, and targeting. But privacy is only the surface layer. What sits underneath is the architecture. The invisible asset structure. Most people keep their wealth in 1 or 2 places. They use a checking account, a brokerage app, or maybe a retirement fund. Self-made decamillionaires do not centralize. They architect. The foundation is the limited partnership structure. Capital commits to a 10 or 12-year horizon. The general partner manages decisions, while limited partners contribute capital without day-to-day involvement. Transfers are restricted, and liquidity is minimal. This is not a bug. It is a design feature that prevents panic selling. When your capital is locked for a decade, you cannot react to every market headline. You are forced into long-term thinking by the structure itself. But the traditional LP is only the starting point. Evergreen private equity funds now offer continuous subscriptions with no capital calls. Capital gets invested and recycled automatically. Minimums are lower than flagship funds, but the structural discipline remains. You do not write a check when a manager calls. Your capital stays deployed, compounding, without interruption. In 2025, The SEC removed the 15% cap on private investments inside registered closed-end funds through ADI 2025-16. This opened the door for interval funds and tender offer funds. These vehicles offer periodic liquidity without daily trading. They sit between a mutual fund and a pure private equity vehicle, and they are increasingly how accredited investors access private markets. You get exposure to private deals without the full lockup of a traditional LP. Then there are co-investment vehicles and feeder funds. Co-investments let select partners participate in specific deals alongside the main fund, usually with reduced management fees and carried interest. Feeder funds aggregate smaller investors into a single vehicle that feeds into larger flagship structures. This lowers minimums and centralizes reporting, but the underlying exposure stays private. The pattern is not diversification in the usual sense. It is nested architecture spanning multiple vehicles, multiple time horizons, and multiple liquidity profiles. You will not find it on a single screen, and you will not track it from the outside. Your brokerage app will not show your LP interest in a real estate fund, and your bank statement will not reveal your co-investment in a secondary vehicle. The wealth is there, but it is just not visible. Structures protect capital from the outside world. The next system protects it from you. The anti-fragile mindset. This is the system most people miss entirely, and it is the most important one. Wealth changes behavior. Psychologists call this the Icarus Effect, where increased resources reduce your sensitivity to risk and create a dangerous illusion of control. You start to believe that your skill built the fortune, rather than timing, luck, or market conditions that could reverse at any moment. This is how fortunes are lost. The same confidence that built the wealth becomes the weapon that destroys it. Most people operate with money scripts they never examine. These include money avoidance, money worship, and money status, which is the belief that your self-worth equals your net worth. These scripts drive decisions from underneath your conscious awareness. You are not choosing to spend or gamble or hide money because a script is choosing for you. Self-made decamillionaires who preserve their capital score differently on psychological tests. They show lower money avoidance and a much stronger orientation towards security and autonomy. A UK study of 90,000 adults found that planning ahead and viewing money as security were the strongest predictors of savings and investment wealth. Impulsiveness predicted lower wealth every single time. The determining factor was not income level, education, or occupation. It was the psychological relationship with money that determined who kept what they earned, and behavioral variables added more explanatory power than demographics ever could. Getting rich requires optimism and risk tolerance, but staying rich requires something else entirely. It requires frugality, redundancy, and what researchers call financial unbreakability. You must structure your finances so that no single event can cause ruin. This means the system absorbs the shock of a divorce, a lawsuit, a market crash, or a health crisis so that you do not have to. Present bias is the enemy because human brains are wired for immediate gratification. Dopamine rewards spending today over security tomorrow, but decamillionaires do not overcome this through willpower alone. They use rules like automated saving, fixed withdrawal rates, and debt limits that are non-negotiable. The rule decides so that you do not have to make a choice in a moment of weakness. The shift is simple to describe, but difficult to live. Money stops being a source of identity or status and becomes a tool for security and autonomy. That is the anti-fragile mindset. Mindset is the foundation, but discipline is what keeps the system operating when your motivation disappears. The capital call discipline. Private equity funds do not spend committed capital on impulse. They deploy it according to a written strategy, on a fixed schedule, and against predefined criteria. Self-made decamillionaires treat their personal wealth the same way. They do not wait until they feel motivated because they follow the policy instead. The implementation is mechanical. Savings and investment contributions happen automatically before discretionary money ever reaches your checking account. Rebalancing occurs at fixed intervals rather than when you feel like it. Withdrawal rates have ceilings, debt has hard limits, and position sizes have boundaries. The system runs whether you are enthusiastic or exhausted, and it continues whether you are patient or panicked. These are not suggestions. They are operating parameters that remove decision-making from moments of high emotion. Buffer maintenance is non-negotiable. Emergency cash reserves, low leverage, and multiple income streams all serve the goal of financial unbreakability rather than maximum returns. Most people optimize for return, but decamillionaires optimize for survival. The buffer is not wasted capital. It is the insurance that keeps the rest of the system alive when conditions turn. Pre-commitment is the final layer of the discipline. You decide your downturn response before the downturn arrives. When markets drop 20%, you rebalance your portfolio. You do not sell, and you do not panic. You follow the policy statement that you wrote when you were calm, because you knew you would not be calm later. The document does not get emotional. It does not read headlines, and it just executes. We are past the halfway point, and here is the system that determines whether the wealth dies with you. The dynasty architecture. Wealth that survives one generation is an accident, but wealth that survives 3 is a system. Most families treat money as a secret. They hide it, fight over it, or pretend it does not exist, and the result of this silence is entirely predictable. Heirs who are unprepared for the weight of capital end up with assets that get divided, diluted, or destroyed within a single decade. The silence around money creates a specific psychological architecture of confusion and entitlement. Entitlement is the fastest way to destroy wealth because it removes the necessity of discipline. Self-made decamillionaires handle this through structured transparency. They speak openly about money values, responsibility, and limitations, which means the younger generation is involved in decision-making through a multi-year apprenticeship rather than a surprise inheritance event. The heir does not wake up at 30 with a bank account they never learned to manage. Instead, they grow into stewardship over years of guided exposure to the mechanics of the family office. Trust structures and governance documents align incentives to control access. Capital is never dumped into an account on a 21st birthday, but is instead released according to milestones, maturity, and demonstrated stewardship. The structure teaches patience. It rewards preparation. It punishes impulsiveness without requiring a parent to say no, which shifts the conflict from the person to the system. The psychology supports this approach. Research on wealth decumulation shows that conscientiousness is the primary predictor of a slower, more conservative drawdown. People who are orderly and forward-thinking preserve wealth longer because they view capital as a tool, not a prize. This is not about restricting heirs. It is about training them. The goal is not to give them money, but to give them the capacity to handle it. Wealth is a stewardship problem, not an ownership problem. You do not own it. You protect it, grow it, and transfer it. That is the dynasty architecture. Wealth retention is a behavioral and structural discipline, not a financial IQ test. If this changed how you think, subscribe. I break down these frameworks every week. The psychology, habits, and mental models of the world's highest performers, distilled into tools you can actually use. Drop a comment below. Which of these 5 systems are you implementing first?